Welcome back to the Entrepreneur's Guide to Financial Statements. Today, we're going to dive deep into one of the most important financial documents for any business owner, the cash flow statement. This statement tracks the flow of cash in and out of your business over a specific period, giving you critical insights into your company's cash management. Let's explore why this document is so crucial and break down its key components. Before we get into the details, let's start with the basics. The cash flow statement helps you understand how much cash is coming in and how much cash is going out during a specific period. Unlike the income statement, which focuses on profit and loss, the cash flow statement focuses on liquidity. Essentially, whether your business has enough cash on hand to cover day-to-day operations and future investments. Cash flow management is critical for entrepreneurs because even if your business is profitable on paper, you can still face serious problems if you don't have enough cash to pay your bills, employees, or suppliers. Now, let's break down the three key components of the cash flow statement: operating activities, investing activities, and financing activities. The first section, operating activities, tracks the cash generated or used in your core business operations. This includes cash inflows from things like sales revenue and cash outflows for payments to suppliers, employees, and other day-to-day expenses. Operating activities reflect the health of your business's core functions. If your operating cash flow is consistently positive, it indicates that your business is generating enough cash from its normal operations to cover expenses. If it's negative, you may need to reassess how efficiently your business is running or address cash flow issues like late payments from customers. Actionable tip: keep a close eye on your operating cash flow, as it's a good indicator of whether your business is financially sustainable on a day-to-day basis. The second section, investing activities, covers the cash flow associated with investments in long-term assets. This includes cash outflows for things like purchasing equipment or acquiring other businesses, and cash inflows from selling assets like property or equipment. Investing activities give you insight into how much money your business is putting toward growth and expansion. For example, buying new machinery or equipment may involve significant cash outflows, but it's an investment in the future productivity and profitability of your business. Remember, high cash outflows in this section aren't necessarily a bad thing, as long as the investments are strategically aligned with your long-term goals and expected to generate future returns. Finally, financing activities represent the cash flow related to funding the business. This includes cash inflows from loans, issuing stocks, or raising capital, as well as outflows like loan repayments, paying dividends, or buying back shares. Financing activities are essential for understanding how your business is funded and how you're managing debt and equity. If you're taking on more debt to grow your business, you'll see significant cash inflows from financing activities. However, high outflows for loan repayments or dividends can also affect your available cash for operations and investments. Now that we've broken down the three sections, let's talk about why monitoring your cash flow is so important. Cash flow is the lifeblood of your business. Without enough liquidity, even the most profitable companies can run into trouble. By keeping a close eye on your cash flow, you ensure that you have enough cash on hand to meet your obligations, fund growth, and seize new opportunities. A positive cash flow indicates that your business is generating enough cash to sustain its operations and pursue future growth. On the other hand, a negative cash flow might signal that you're overspending or not collecting revenue quickly enough, which could lead to liquidity problems down the road. Here are a few practical tips for managing and improving your cash flow. Forecast your cash flow. Create a cash flow forecast to predict future inflows and outflows. This helps you plan for periods when cash may be tight and allows you to take action early to avoid a cash crunch. Accelerate receivables. Encourage customers to pay invoices more quickly by offering discounts for early payments or requiring shorter payment terms. Delay payables. Negotiate longer payment terms with your suppliers. The longer you can delay cash outflows without damaging supplier relationships, the better your short-term liquidity will be. Maintain a cash reserve. Always aim to have a cash cushion in case of unexpected expenses or downturns in revenue. Having reserves will keep your business stable during lean times. Monitor inventory levels. For product-based businesses, managing inventory efficiently can free up significant amounts of cash. Overstocking ties up cash that could be used elsewhere, so balance your stock levels based on demand. In conclusion, the cash flow statement is one of the most vital tools in an entrepreneur's toolkit. By understanding how cash flows in and out of your business through operating, investing, and financing activities, you can gain valuable insights into your business's liquidity, sustainability, and ability to grow. Remember, positive cash flow ensures that your business can continue operating and invest in future opportunities, while negative cash flow can signal the need for adjustments in how you manage your finances. By regularly reviewing and understanding your cash flow statement, you'll be in a much stronger position to make informed decisions that drive long-term success. Thanks for watching, and don't forget to subscribe for more insights into financial management and business growth.